Hi everyone, welcome to episode 90 of the Rewarding Property Decisions podcast. I'm very fortunate today to be joined by two of my colleagues, Brenton and Jarrod Telfer. Thanks for joining me, guys.
Jarrod.
Thanks, Jarrod.
So today we're at our last formal podcast for the year, and so what we're going to do is go over the market and how it's performed, but also have a bit of an in-depth look at how the market's moved and what have been some of the driving forces, some of the issues and the trends that we've observed and we think are influencing the market or have influenced the market this year and will have a continuing influence going into 2025. So there's been a number of points, and that's what we'll go through. Some of the things that I've observed and I think have big influences have been probably the stability around interest rates. So we've seen in the past some pretty significant increases over a relatively small space of time. Investor sentiment and some of the impacts that changes in legislation have had, whether that's around expectations on investors maintaining properties or whether it's around land tax changes. And then some of the property management from that side of things, the leasing market and the fact that the rental market is continuing to build, but also the fact that vacancy rates are quite tight. And I think land tax has been one of the bigger influences. But from you guys, what have you noticed and what do you think, Jordan, that you think, we've had a number of discussions, but it's probably not necessarily been one thing from your perspective?
No, I think that the trend really through this year has just been a lacklustre market. It's neither one thing nor the other, and that's probably reflective in the median values, I suppose, and how they've been reported as dropping away. Yeah, they have, but not significantly, not in a normal downturn.
Yep.
So it's very different to, say, 2018, when there was a downturn after a few years of a rise.
Yep.
You could palpably feel that at auction, people turning up to basically take advantage potentially of a stressed vendor, then walking away to the next one if they didn't buy it for a particular price. There's still good property selling for good prices.
We've seen a few lately, haven't we, where there's been really strong competition, not just one or two bidders, but 5 and 6.
Yeah, it's not consistent right through.
No.
It's certainly not consistent in geographic location or sector or type of property. It's just a bit of, and we've seen that this spring where it never really kicked on. The quality was fairly ordinary. Come to that later.
We tend to see that though too in the back half of the spring market, don't we? Because there's a lot of the people that are selling from basically mid-November onwards are not choosing to, they need to. Now that's not necessarily from financial stress, it's because perhaps they've bought something else. But typically they're upgrading for some reason, and therefore probably what they're upgrading from is, in a lot of instances, a lesser quality property.
Yeah, I think that's indicative too, and we'll probably tease this out as we continue on. But from my perspective, it's been numbers have been lower, but the quality, what we term a quality, has been even lower again. And I think that's probably symptomatic of the type of property being brought to the market, be it houses or apartments, and that's being driven, I think, by a lot of investors looking to exit the market.
What have you seen, BP?
I guess more of an understanding for buyers now in the market, probably your entry-level buyers, for interest rates, and the cash rate hasn't now moved in 12 months. I think the last time there was a movement of the cash rate was November 2023. So I think that's the new norm for buyers, and they're just going to have to live with that as an expectation moving forward. That we're not going to get that mass reduction in interest rates again from the RBA, and so buyers have now got a little bit of confidence moving forward that look, there may be a reduction early next year. If not, it looks like things are staying on hold. I've got a good idea or indication of what I may be able to borrow, and that's not going to change anytime soon.
So one of the other things, I guess, that we've noticed as a business this year has been, and one of the things that we monitor is obviously the inquiry numbers and where they're sitting. Now, we're not going to go into detail on those sorts of things, but as a breakdown, we tend to look at inquiries from either home buyers, investors from a buying perspective, or disposals, which obviously is a sale of property or our vendor advisory service. And the thing that's become quite apparent over the last 12 to 18 months has been looking at the stats. Back in 2022, we had, as a proportion of our inquiries, 22% were disposals. 2023, it jumped to 38, and this year it's jumped to 40%, which is a significant proportion of our inquiry levels. But it shows that there is a lot of interest or far more interest from a selling perspective than perhaps what there is from a buying side of things. So what do you think has driven that change in mindset to be more of a higher level of supply in the selling side of things than an inquiry from a buying perspective?
I think that there's probably three key things.
Yep.
And one is clearly interest rates.
Yeah. It's getting to a point where they're starting to bite.
Very much so. And the rental market has been strong.
Yep.
And owners can expect to see a significant increase in their rent over probably the last 12, 18 months, whatever it might have been. But a lot of our clients are saying that's all well and good, but what I'm at now forking out with the increased mortgage rates, it's more than...
It's getting eaten up.
It's getting eaten up
then you're having to pay land tax on top of that as well.
And then there's probably that second part of it is the extra regulatory and the extra costs that have been borne, I suppose. Some of them I think are reasonable in a way, in that the changes to the Residential Tenancies Act require properties to be kept in a certain state, and I think some of those are very good and needed. But then a lot of people this year who were never accustomed to paying land tax, those that own apartments particularly, with the reduction in the threshold, it's a pretty rude shock.
Well, basically, there's not really anyone now who owns a second property, whether it's investment, whether it's lifestyle, that doesn't pay land tax.
Yeah.
There's not many properties that don't have at least a $50,000 land component.
Yeah. And I think a lot of people can absorb these and are prepared to absorb these sorts of costs if they see them as being reasonably temporary.
Yeah.
A lot of them are baked in and aren't going to be temporary. But if there's the capital growth to offset that, which is why you get into it in the first place, well, you can accept that. Whereas unfortunately, with a number of apartments, a lot of the newer stuff has actually dropped away in value. But even what you regard as good quality stock, with all the right locations and attributes, we've seen very stagnant conditions for a long time now.
And what's the third point that you were...
Well, it's probably those three things. Lack of capital growth, and then all of the outside, with the interest rate increases.
So going into 2025, are we expecting that to change? Or is it likely to continue on? What do you think in terms of the supply and the breakdown because our inquiry numbers are generally a pretty good indicator of the market as a whole, and I think that shows that if our disposal numbers are up, and we are seeing that the selling numbers are up as well, and if our buyer inquiry is lower as a percentage, that's a reflection of what the market is seeing at the moment as well. So is that what we expect next year?
I would think so. That should probably continue. Even if we do, not to harp on interest rate reductions or rises, but if even one's not going to change too much, I don't think, in the overall scheme of the market. Sentiment may change for buyers, but as you said, that those new taxes that have been implemented, Jordan, that will have an ongoing effect and can be a root shock for some of our investor clients as well.
Yeah, I think that unfortunately, the first few months of next year, even though that traditional early part to a calendar year tends to be a good time to be selling your property if you're needing to sell a property within your calendar year, that we've always found that there is a bit of an imbalance between supply and demand in favour of those selling, and there's a renewed enthusiasm there tends to be once you get to the end of the year and buyers start to get their head back into the marketplace and are looking for a start to the year, in a number of areas, but that can be with whether they want to make a move in their own home or an investment or whatever it might be.
Yeah. So
that tends to be quite good. I would have all hoped that we would have probably seen an interest rate decrease to give that little extra spark. Now,
it's not coming
if that happens in February, then it's probably indicative of there being problems.
From what we're seeing, they're not likely to be in the first half of the year. I mean, the talk from the RBA is not. It's not likely to come sooner. Rather, it's not meant to be. It's not going to become too soon. I don't think. I think it's going to be later next year that we will probably see it.
We've always said, I think that that spark is what the Melbourne market needs.
Yeah.
It's yes, there's affordability that comes in with perhaps a couple of decreases. So that will certainly help out in terms of affordability, but it's also the confidence.
Yeah,
and I think that's people as well, and the sentiment.
It's not likely to change give it a drastic kick or anything along those lines. It might just give that little bit of a spark to turn mindset and give people a bit more confidence, but it's not going to lead to all of a sudden a 15-20% jump in prices.
Can't see it.
No. is it, given that we've seen that increase in supply and the reduction in demand, and we have seen prices slowing, that's what's fed to that point we made earlier about Melbourne as a comparison to other cities being quite good value. Do you think that's going to get emphasised even more next year? And is it going to take an interest rate cut for people to then start to say, okay, well, it's getting too good a value now, particularly if interest rates start to come down, the yields continue to go up, if values aren't moving and the rents are going up, it's going to help yields. And at some point in time, you would have to think that investors are going to say, no, look, even with the increased land tax and even with these other costs, this is too good to pass up. It's just a question of whether, I'm not convinced that'll be a 2025 turning point. I think it'll be further down the track. It will happen. I just don't think it'll be next year.
Yeah, I find it interesting. I'm not sure about your experience, Brenton, but I've had a couple of inquiries from people out of interstate and particularly out of Sydney.
Yep.
Because there has been a little bit more in the media about, well, Melbourne is appearing to be quite undervalued compared to the other state capitals.
If you look at the investor loan rates around the country, they're up and they're quite strong. It's just that they're not in Victoria.
Yeah.
But those wanting to invest are still investing in other states. And that's what I think that could be a turn, is that it's not necessarily Victorians investing in Victoria, it's interstate thinking that, well, I don't own anything else there. So yes, I'm going to have to pay land tax, but I can factor that in as part of my costs. I know it up front, as opposed to some of the existing investors who are getting hit with something that they never factored in. So perhaps that will bring a few interstate investors into this market.
Yeah. I spoke to a lady from Sydney the other day, and she was shocked to know that $1.5 million would get you an inner city terrace home in Melbourne's inner ring.
Yeah, well, you'd be lucky to get an apartment for that in the inner suburbs of Sydney.
Yeah, that's right. So yeah, she was pleasantly surprised.
So that then leads us to the buying side of things and looking at the buying breakdown of what we're seeing. And the investor side has really dropped off. So from our perspective, back in 2022, as a proportion of our inquiries, 38% were around investment activity. Back in 23, last year, it dropped down to 33%. This year, it's dropped below 30%. We're at 29%. So that investment inquiry is just been slowing. So at some point, for the reasons we've discussed, you'd think it's going to turn. But is there anything from the trends and things that we've seen that you think could be a tipping point? Again, is it likely to be next year, or is it going to be further down the track that you start to see a tipping point and that starts to reverse and we might see the inquiry start to lift again?
Well, you'd think if vacancy rates continue to stay at an all-time low, rents continue to rise, I mean, we do need investors in the marketplace for there to be more, property for people to rent out. So,
well, you said to me, I reckon that, I think it was you that said to me, someone said to me the other day that investors haven't been influential within the property market, as in being a real influence in their sector, since probably the Royal Commission in 2017.
It was 17 that things started to peel away. You could distinctly see it.
Yeah.
And so it's been underpinned. It was always, and this probably feeds into the apartment market more than anything.
Yeah.
It was always, the apartments worked really well when there was that competitive tension, I suppose.
First home buyers, investors, downsizers. Yeah.
Now, good property, good apartments have been underpinned by first home buyers.
Yeah.
And it's enabled them to at least maintain value, perhaps a slight increase, but not what we were seeing in a couple of decades before that.
Yeah.
That which was investor grade stock, so the stuff that we've never particularly been enamoured with, so the new apartments and the high rises, well, that was strictly speaking investor grade stock. That's what the significant reduction has been.
Yeah.
But it's just that competitive tension that is probably needed for that sector of the market to start
to kick again.
Yeah.
And then the home buyer sector, we're seeing that's been very consistent from our inquiry perspective. We're seeing that it's been from over that sort of 3-year period, it hasn't really fluctuated far from sort of 30 to 35%. It makes up a pretty consistent proportion. Is there? I mean, I guess it's to do with the fact that we all want homes and there's a want for that. Perhaps there's a little bit less of the upgrading as a proportion, which we saw a lot of during the pandemic. And typically first home buyers dropped off the perch because they were focused on just consolidating themselves, whereas we are seeing more of that at the moment. And there's some good opportunities around because investors are looking to sell.
Yeah, I think home buyers are less worried about, well, it's important, but numbers, capital growth in the year, it's more of a lifestyle decision for them.
Yeah.
So they're less impacted on those. I guess that those market influences long term. It's more around, okay, if the right property comes up for me, in the right school zone, or if I've been looking for a property with a swimming pool in these particular suburbs, I think there's a really good opportunity here. They're less impacted by the potential rental yield if they're living in it, or the long-term capital growth, because the plan for a lot of home buyers, particularly if they're upsizing, is to have an 8 to 10 year period in this home.
Yeah. So. Well, you'd hope so. Sometimes they do get a little bit caught up in the short term, but they should be, and that's why I guess we have that discussion regularly about it needing to be a sort of 5 to 10 year exercise minimum, whether you continue to hold the property depending upon what you're up to, or whether it's a upgrade type scenario.
Yeah.
In terms of looking ahead at the market for next year, I know we've had these brief discussions. Is there anything specific or particular that you're really looking forward to seeing how something plays out, or something that you might think will influence the market next year?
Yeah, maybe it might have a longer term horizon than just next year, but the build to rent sector of the market, because
there seems to be a lot in the pipeline that's about to come to fruition. I was talking to a friend who's in that space, in the development space for that, and there's a huge amount that's in the pipeline ready to be completed. I think.
And probably more of that coming on than what there would be, or what's expected anyway, for standard apartments that are
built to sell.
Built to sell sector of the market. Yeah. So that will be an interesting one to be looking at next year and
see what happens.
In a couple of years.
What it does to vacancy rates and to general. Because the understanding is that most of these properties are premium type rental products. Like they're not just going to be entry level 1 and 2 bedroom apartments where you can spend $400 a week or $550 a week for a 2 bedroom. It's going to be $750, $800 a week for a 2 bedroom.
Well, and that's potentially where that sector of the market might end up maturing, diversifying, whatever it might be, and that not everybody can afford that. Yeah. And really, not everybody necessarily wants. I know this is the way it's pitched, but the communal areas. Yeah. There might be some people who say, well, I'm prepared to forego.
I like my gym. I don't need to use yours.
Don't need the bowling alley.
I don't. Yeah. The movie theatre, the communal kitchens, certain areas that works, and that's great. Yep. But that comes with a cost.
Yeah.
And this is where it'll be very interesting to see that the impact of the build-to-rent market on what the traditional market has been.
Yeah.
Whether there's still a place for it now, whether it's by design or whether it is just a function of government policy. And we're certainly seeing investors remove themselves in large numbers from the established sector.
Yep.
It's well and good, but even if that's being backfilled by if those properties are being backfilled by home buyers, which seems to be the intention, there leaves a gap in the market. Yep. So the inner suburban house, where do people go? They don't necessarily go into the build-to-rent stuff.
No.
That's what I'm curious to see how the market dynamics play out with a significant change, or it will be a significant change to the diversity of the product offering for people just simply looking to rent.
Yeah. BP, what about you? What for next year?
I think, the older style apartments, they've struggled, or not struggled. We haven't seen that really good growth from them in a number of years. But I just think this, if positioned well in the right block, there's still a space for them, and I'm interested to see how the growth turns out for them next year, and how the interest levels, and if we get young first home buyers getting back into the marketplace there, that are looking to potentially, mum and dad have had the home in Camberwell or Hawthorn, they want their kids to be close by. I think there could be some value to be had there in terms of what might be on the market next year.
And I think the other thing too that, Jarrod, we've noticed over the last few years to see whether it accelerates, particularly if the environment becomes far more conducive for development and developers to get back in, is is the
underlying land value.
The underlying land
development.
value. Yeah, exactly. And so a lot of these apartments sitting on extremely valuable and increasingly valuable blocks of land, whether it gets that tipping point is reached where
it's happening more and more often.
It's more and more often, and it's creeping out further and further into areas that wouldn't have been a couple of years ago because the land wasn't valuable enough for it to justify a conversion for that purpose. So
it always started in, and we expected that, it started in the bluest of blue chip areas, and it still predominantly is in that space, but as you said, it is starting to creep a little bit further out. Any notable things, occurrences, transactions, things that you've dealt with clients this year?
Let's see.
Just things that have happened within the marketplace that have been of interest.
Yeah, I mean, I had a disposal earlier this year in West Footscray. The owner had owned the property for 20 years and had the same tenant for the same time as well. So, look, it was in pretty ordinary condition when we got in there. Myself and the agent, we went through, made a recommendation in terms of cosmetic upgrades. We thought the property was probably worth just if on its own land value probably somewhere between $750,000 and $800,000. Spent about spent about $30,000 or $40,000 all up, and went to market. Ended up getting 3 bidders on it. It had that owner occupier appeal, but where people could move into it. Organised plans. This was a weatherboard, kind of a post-war weatherboard home on about 350 square metres. So not big enough to actually develop, but big enough for someone to either move in. It was a nice enough spot in West Footscray to eventually either knock it over and build their own home or renovate within the existing structure. Really competitive auction there. Yeah, 3 bidders. Ended up selling for about, I think it was $917, which we were really shocked with. I was inside as vendor advisor on the auction with the vendor. She actually noticed one of the bidders outside, and she said, I'm aware of that gentleman. We've got a mutual friend, and I was sharing a beer with him in Ireland. A Guinness, I'll get that right, a Guinness with him in Ireland a number of years ago. And then she turned and said, I hope he buys it. It was on the market. I turned to the vendor and said, look, it's on the market now. It's over to the general public, but we can't stop the auction. He ended up buying the property, walking inside, and when they met at the front door, there was a hug and a handshake and a congratulations. And the purchaser turned and said to me and the vendor, well, you owe me more than just a beer now.
Small world.
Yeah, such a small world. But yeah, that was certainly an interesting story from the start of the year. Jarrod, do you have any?
I haven't had any real standout things this year.
Again, it just comes to not that it's just been a funny year. It's just sort of it's gone quickly, but and there's been a lot to discuss and a lot to talk about. But the market has just been a bit indifferent. Yeah, that's probably the word for it. There's been no buzz, and you sense a buzz one way or the other in a market normally. You can just. It's palpable sometimes when you get through open for inspections as to, okay.
Yeah, and it'll be interesting when we get back to doing them next year, because sometimes you can get back and think, geez, this is different. This is not the same as what it was and we all know that you'll get the media buzz in January when people will be saying, oh, there's a lot of people that open for inspections. Yeah, because there's not many properties to look at. So everyone goes to the same properties, and so there's always high numbers. But the testing point is when you get into the sort of mid to late February and we've got a fully supplied market, are we getting good numbers at that point in time? And that's when you start to see a few auctions, and is there multiple bidders, or are we still dragging the chain a little bit? So that'll be the testing point. But I think next year is more likely to be similar to this year. I don't think there'll be any drastic changes. Yeah. I mean, are we expecting a price movement one way or the other, or do you think it'll be? I mean, I think within the sort of 2-3% either way, it's going to be pretty similar to this year.
Yeah. I think so. I can't see in the absence of interest rate reduction, certainly in the first half of the year. Perhaps it might come in May. Who knows? We've been saying this for the last year and a half. I think it'll be pretty similar to what we've seen the last 6 to 12 months, really. Yeah. It'll just be interesting to see when interest rate reductions do come in, whenever that is.
What happens?
Yeah, what happens there? Does that? And I think it'll be more around the confidence that it gives people, I think.
Very good. All right, well, that's probably about it. Thanks very much, guys, for joining us today.
Thanks, Jarrod.
We'll get you back again
Always
next year.
a lot to talk about.
Yeah, it always is.
Yeah.
So that's episode 90 of the Rewarding Property Decisions podcast. Thanks very much for joining us. As always, please feel free to share the podcast far and wide with friends, family, colleagues, anyone who has an interest in property. And if you'd like further information, visit our website, wakeland.com.au. Otherwise, we wish you a very merry festive season and plenty of rewarding property decisions for you in 2020.